Hey, what's happening? This is Jerry over at Wealth Dynamics coming to you today, cracking with our daily money clip. I want to talk to you today because it's Black Friday as I'm doing this video, and I want to discuss how I handle large purchases because a lot of people today, they might go out and they might buy furniture or they might buy a TV or they might buy a new car. And I want to kind of discuss how I personally go about handling this kind of stuff with my sacred account because if you're buying items like this, really, you're putting yourself in a position where you're either financing money with the bank, meaning I'm going to give up income. I'm not even worried about interest. I'm worried about the income. I'm going to give up income for a period of time, and I'm never going to see that income back. Right. So if I have a car payment, I'm going to give the bank 300 or 500 or $1,000 a month on my car for the next 60 months or the next 80 months. That's really what I'm losing out on. A lot of people think it's the interest. So I'm either doing that or I'm giving up future value on money. Meaning, if I'm going to buy a car or a TV or furniture or whatever it might be, and it costs me $10,000 and I take cash and I pay cash with that $10,000, I'm losing the 10,000. I never see that money again. So let me show you what I mean by this. So I want to use my whiteboard today, and I'm going to sketch this out so that we can kind of all be on the same page with what we're discussing. So let's say I'm going to buy something today on Black Friday for $5,000. Okay, kind of a nice in the middle number that most people could justify spending on something. I'm going to pay $5,000, right? Now, if I'm going to pay $5,000, like I said, I've got usually two options. So the first option is I can finance that. So let me get my investing calculator out. Let's say I finance that at 8% for 5 years. Okay, so $5,000 at 8% because I'm financing it times, we said 5 years, so it's 60 months. Okay, so if I do that, what I'm doing is I'm losing out. This payment is going to be about $101 a month. Okay, 101.38 would be my payment if I'm trying to finance something at this rate. Now realize that $101 is money that I'm giving away. I'm giving that to a bank. I'm giving that to an institution. Okay, if I look at it from the standpoint of total value, it's 101.38 cents times 60 months. Over 60 months, I am paying a little over $6,000. 6,000. Let me clean that six up for you. I'm paying 6,082. We'll call it $83 a month total over the 60 months. That's my total out of pocket cost, right? So I actually lost $100 a month for 60 months, a total of $6,000 that I'm losing. My other option is to just spend it $5,000 in cash. Okay, on this, I've got theoretically no monthly payment, right? Well, let's check this out because I don't quite agree with that. So if I have a present value of $5,000 and let's take the same 5-year period, real inflation is about 5%. So I'm going to put a 5% rate there. That means that after 5 years is done, my $5,000, if I would have kept it, is only worth about $4,800. The item I bought, let's say it's a couch, probably depreciated. It's only probably worth about half that, right? So I took $5,000 and I turned it into like $2,500, right? Now, meanwhile, let's say I could have been earning on this $5,000 instead. Let's say I'm earning 5% on this $5,000. My $5,000 could have been worth, instead of $2,500, if I would have been investing this $5,000 instead, it would have been worth $5,105. Okay. So this is, again, what option one is and what option two is. This is how most people buy and finance things. I'm talking about today, now that we're on the same page about what most people are doing, I'm going to talk about what I do. Okay. What I do is very different. I buy things and self-finance them with my sacred account. Here's what I mean. Okay. So let's say that I have an item that costs $5,000. $5,000. Black Friday, it's on sale. I'm going to get it. I'm going to take a policy loan against my sacred account. My sacred account is my life insurance policy. So I'm going to borrow $5,000 against this $5,000. Okay. I'm going to take this $5,000 that I've borrowed against my policy. I'm going to go buy, whatever the item is. Right. I'm going to buy this. Now I own it. Right. Now, what I'm going to do, what I will personally do with this is because my 5 grand in my account is growing at a average taxable equivalent compounding rate of about 3 to 5%. That's what I'm making. This loan here is costing me usually about 1 to 2%. The way that I do my account, it's going to cost me about 1 to 2%. Okay. So that means that my $5,000 is still growing at 3 to 5%. In 5 years, I'm going to have more than $5,000. Let's check out what I'm going to have here. So we said, if it's growing at 5%, I think that puts me around $5,100. Yeah. So in 5 years, I'm going to have $5,100 in my account. So I'll have my original 5,000 plus I'll have earned $105 in interest, right? And what I'm doing this entire time is I'm going to take this $5,000 loan and I'm going to pay myself back a payment with it. So I'm going to pay myself $100 a month on a loan payment. Okay. Now, this looks complex, but it's not. I had 5 grand in my sacred account. I took a loan against the 5 grand that's in my sacred account. I bought the thing which costed $5,000. My 5 grand is actually still growing. I'm paying less in interest than it costed me to borrow because I'm making a profit. I'm earning 3 to 5, paying 1 to 2. On top of that, I'm going to pay myself $100 a month payment, right? So I'm going to pay this loan off. In 5 years, I'll pay the entire $5,000 loan off to myself. When I pay it off, I'm going to have $5,100 instead of just the 5,000. Okay. Now don't forget, in 5 years, let's say this was my couch. We already said this couch depreciated. It's only worth half of what I paid, but I now have to have $2,500 because I have the value of the couch. If I were to go sell the couch, right? So in scenario 1, I financed it. Okay. I didn't have the money. I had to borrow the money. I paid $101 a month for 60 months. It cost me 6 grand. And at the end of it, I don't have the 6 grand anymore. I just have a $2,500 couch and I've paid 6 grand to own it, right? In option 2, where I paid cash for it, I took my $5,000 in cash, bought the couch, had no payments. And in 5 years, the couch was only worth $2,500. So I turned my 5 grand into $2,500. Option 3, we're going to call this with the sacred account. I took my 5 grand, borrowed it from my account, bought the couch, Black Friday sale, $100 a month. I paid myself back over 5 years because I was going to make a payment anyways, but I'm going to make it to the Bank of Jerry instead of to the Bank of America. And at the end of this, I've got $5,105 in my sacred account, plus I have $2,500. Okay. So I actually have $7,605. Okay. That's my 5 grand is now worth $7,605 in 5 years. Okay, I have made money on buying a couch, guys. This is why I freaking love the sacred account. I just made money buying a couch. It's a couch. Now, if I really want to get creative, then I own a C corporation and I bought the couch with my C corporation, and it's an employee fringe benefit, and it's in my house or my home office or my office, and I allow my staff to use it whenever they want to. And now I can also deduct this $5,000 expense off of my income. Okay. But this is what I wanted to cover today. How to make large purchases with the sacred account is Black Friday, guys. Black Friday, historically speaking, shouldn't even be called Black Friday. It should be called Red Friday. The reason why is Black Friday, excuse me while I take a sip of my coffee, courtesy of Mises Institute. I've got my End the Fed mug here. So Black Friday originally was created as a ploy by the retail industry. Okay, decades and decades ago, this happened. They were not in the black, meaning they were not profitable. When you talk about a balance sheet and a cash flow statement, in the black means I made money, in the red means I'm losing money. They were in the red. So they came up with Black Friday as a way to get in the black, meaning they're going to put everything on sale, increase their revenue, their volume, so that they could be in the black for the end of the year. Now, the flip of this is that you're going in the red. For them to be in the black, you've got to go in the red because it's your money that they're getting. So I wanted to hit this video today because a lot of people go out today, they buy stuff, they finance things, they get the new car, they get the new furniture, they get the TV, they get the whatever, and they end up going in the red for the stores and the banks to go in the black on Black Friday. If you're using the sacred account, Black Friday can actually be Black Friday for you too. So that's what I wanted to hit today. Guys, if you have any questions on this, reach out to me. Again, excuse me, we do these every day. I try to do these every day. And these are topics that are daily money clips. They help you keep your money together. So I just showed you instead of losing money by spending cash on things, instead of losing money because of interest financing costs? How can I be my own bank and make the money instead? That's all I've got today. Make sure you do like, share, and subscribe, and I will talk to you all next time.